Abdul El-Sayed, the Democratic nominee for the United States Senate from Michigan, has publicly committed to advancing a tax system that he characterizes as fair for working people, and aims to ensure that the wealthiest individuals contribute proportionately. However, recent financial disclosures and tax documentation indicate that Dr. El-Sayed, himself among the top 1% of Michigan earners, has structured his personal compensation in a manner that experts identify as advantageous under current tax provisions. According to filings encompassing the entirety of 2025 and the first 7 months of 2026, Dr. El-Sayed reported paying himself a $64,000 salary via AME Higher LLC, a consulting entity he established. In addition to his salary, he received $103,000 as a member draw, reflecting company profits allocated to him as the owner. This approach is commonly utilized among business owners to minimize liabilities associated with Social Security and Medicare payroll taxes. If an individual were to classify the full $167,000 as salary, it would be subject to a self-employment payroll tax rate of 15.3%. However, under an S-corporation tax election, only the reasonable salary amount is subject to these taxes, with the remainder treated as distribution of profits and therefore exempt. Accountants familiar with these structures note that this bifurcated compensation scheme persists as a legal, albeit controversial, tax strategy. The Internal Revenue Service requires S-corporations to pay owners a reasonable market rate salary, but profits paid beyond that amount are not subject to certain payroll taxes. This method, sometimes referred to in policy debates as the Gingrich-Edwards tax loophole, has attracted periodic legislative scrutiny, with efforts to curtail its use occurring under multiple administrations without success. Notably, it has been employed by figures across the political spectrum, including John Edwards, Newt Gingrich, and Joe Biden. Legislative initiatives aimed at closing these tax differentials have been advanced by Democratic lawmakers. For instance, Sen. Sheldon Whitehouse introduced legislation targeting pass-through income for high earners, while Sen. Ron Wyden proposed measures to address the usage of pass-through entities to reduce tax obligations. These bills specifically target the ability of business owners to categorize earned income as business profits, thereby minimizing payroll tax contributions. While Dr. El-Sayed has released some elements of his 2025 tax return, certain details crucial to confirming the exact tax treatment of his consulting firm remain undisclosed. The available documents suggest that substantial portions of his income were reported as W-2 wages, which is consistent with the tax treatment of an LLC electing S-corporation status. Additional income streams identified include consulting fees, speaker honoraria, book royalties, and revenue from rental properties, some located internationally. Despite advocating for the elimination of tax loopholes and expressing support for the taxation of substantial capital gains and the removal of preferential treatment for the wealthy, Dr. El-Sayed's own reported financial practices reflect the continued reliance on longstanding and legal strategies to reduce tax obligations. His stated position on issues, such as closing the Social Security payroll tax cap and opposing corporate tax breaks, stands in contrast to the mechanisms disclosed in his own financial arrangements. Dr. El-Sayed's household income in 2025 exceeded $686,000, placing him among Michigan's highest earners. Additional reported income is attributed to his spouse's medical practice, which, according to public information, does not participate in Medicare, while Dr. El-Sayed has been a vocal proponent of Medicare for all. Property holdings further include 3 rental properties, with 2 located outside the United States. The intersection of Dr. El-Sayed's financial